Corporate Finance PowerPoint presentation. In this presentation, we will discuss statement of cash flows. Get ready, it's time to take your chance with corporate finance. Statement of cash flows. So remember, when we're thinking about the financial statements, we can think about them as answering two major questions to users of the financial statements. For example, if we're thinking about investing to the company in some type of way and are using the financial statements to help us make a decision with regards to that, we want to know, where does the company stand at this point in time? What's basically their worth at this point in time? For that, we get help from the balance sheet, which is going to give us the assets, liabilities, equity, assets minus liabilities equaling equity, which is basically the book value as of a point in time. So if, for example, we have the financial statements for the year ended December 31st, the balance sheet will be as of the point, the last date of the time range, December 31st. And then we want to know, well, how well will this company do in the future? Are they going to make us money if we were to invest in them? Or if you're a bank, you're questioning, are they going to be able to pay off the loan if we loan them money? Or something like that. For that, we need the timing statement. We would like a timing statement that tells us how the performance will be in the future, but we can't do that. So we have to look at the past in order to think about how they might do in the future, just like we would with any kind of performance metric for anybody doing anything, like someone working at a job or someone who's does sports or something like that. How many hits did they have last time? How many, stats did they have last year compared to what we think they're going to do next year? That's going to be the income statement. These are the primary two statements that you want to be thinking about. Then they're going to answer the most questions. They're going to be the balance sheet. Where do they stand at a point in time? Income statement. How did they do to get in, the last season? How did they do last season? How did they do last year? How they to predict how well they're going to do next year. But then we need a linking statement. That's going to be the statement of retained earnings. So that means that we're going to tie out, that's going to be the statements that's going to tie out the balance sheet before the period that we're working on to the balance sheet that we're working on in this period. So these two statements, balance sheet, income statement, primary two statements, the statement of retained earnings, kind of linking those two statements together and to the prior period. So these are the major components you want to think of with the financial statements. When you're thinking financials, you're thinking balance sheet, income statement, and then you're thinking retained earnings is going to link balance sheet, income statement, and link to the prior period balance sheet. These statements, however, are on an accrual basis. An accrual basis is typically thought of to be best for measurement purposes, for performance purposes, rather than a cash basis, because an accrual basis is going to recognize the revenue and the expenses on the income statement, the timing statement here. When the revenue, you're going to recognize revenue when work was actually done, and you're going to recognize expenses when you actually consumed the expense in order to generate revenue in the same time period. You might ask, why don't you just recognize revenue when cash is received and cash is paid? You could do that, but it's easy to distort things when you do that by simply changing the cash flow. So then you can just change when you're going to receive the revenue, or when you're going to pay, or when you're going to receive the cash, or when you're going to pay the cash. And that could be an easy way to then distort the financial statements. So we don't want to distort the financial statements. We want to basically represent, the true earnings and the true expenses on the financial statement, even if we have not yet paid cash, even if the cash is going to be paid or received at some other date. But the cash flow statement, the cash flow is really important. Cash is going to be like the blood of the economy. It's the thing that makes everything work, right? It's going to lubricate the whole economy here. We need to know that cash flow is okay. So therefore we want to add to it the statement of cash flows. So the statement of cash flows is then going to be added on to give us those cash flows that we don't have on the income statement, because now we're doing the income statement on an accrual basis. Therefore, you want to think about these statements up top as being done together. If you were imagining creating the financial statements, you would do these first, because these are the statements that are basically, the bookkeeping is done in the accrual basis statement, meaning when you enter the information into the financial data, we're basically putting together and constructing on an accrual basis, typically the balance sheet and the income statement, statement of retained earnings. And then you're going to take that information, rearrange it from an accrual basis basically to a cash basis, so that we can then also see the cash flows. Cash flows will also be a timing statement. It's going to tell us how we have done over the time period. It's not as of a point in time. It's going to tell us how we have done. It ties into the balance sheet, but it's going to tie into the cash component of the balance sheet. In other words, the retained earnings we said kind of tied out the income statement, the balance sheet in the prior period, and the balance sheet of the current period. The statement of cash flows is going to tie out the cash from the prior period to the cash in the current period, and it's going to tell us the flows, the activity that has happened during the period. So here's going to be our financial statements. We've got the balance sheet over here, assets equal liabilities plus equity. We saw in prior presentations the income statement, and the income statement is the activity statement, but it is on an accrual basis. The income statement is on an accrual basis, meaning this revenue up top represents revenue because we have done work in order to generate or earn the revenue in accordance with an accrual concept called revenue recognition, and all the expenses are on the books because we have actually incurred the expense at the point in time, in order to help us generate revenue in the same time period. So, for example, this cost of goods sold up here is an example of an accrual kind of thing, because the cost of goods sold represents the cost of the inventory that we are consuming at this point in time. We didn't actually buy the inventory necessarily in this year, because when we bought the inventory, we put it on the books as an asset on the balance sheet over here, and then when we consumed it, we then expensed the inventory, reducing the inventory on the balance sheet and recording the expense, so that we recorded the expense not when we paid the cash, but rather when we consumed it in order to help us generate revenue. The depreciation is another primary example we'll take a look at in the future, which basically is related to the property, plant, and equipment. So for example, if you were to pay cash for a building and you paid $300,000 for a building cash, it would really distort things if you were to put an expense in the current period related to that purchase. Why? Because that building's going to last hopefully for a long period of time into the future. And so if you were to compare this statement to another statement, this year to next year, the building, a $300,000 expense, would distort the comparison greatly. So what we do instead is we deviate from the cash basis to an accrual basis. We put the building on the books as an asset, and then what we do is we depreciate it. It's called depreciation. And we record the depreciation, which is allocating the cost of the building, whether we bought it for cash or financed it, allocating the cost of the building over the time period in which we consume it to generate revenue. So that's going to be another example, and we'll see that example when we construct the statement of cash flows as a primary difference. But you can see the income statement then is not on a cash flow basis. So that means that we're gonna want another statement that gives us the cash flow. So you can see why we would do that on the income statement, hopefully, because it helps us to measure on a performance measure basis. But cash flow is also, like we say, very important. We need to know what the cash flow is too. Therefore, we're going to tack on then to the statements a statement of cash flows. So remember that the statement of cash flows you can think of as kind of separately. If you're going to construct this thing, you would make the balance sheet and the income statement, and then the statement of retained earnings is tying together the balance sheet and the income statement. These three statements are just made, you just construct these, when you're doing a normal accounting system. These are all normal components of the construction. They all come from like the same general ledger, the trial balance. They all, just come from that same component. They're all part of the same piece. You can think about these three items then being reworked, in essence, to get to the statement of cash flows. So the statement of cash flows is going to show the change in cash. So this whole top part of the statement of cash flows is going to be showing basically the change in the cash over a time period. So this is the net increase in the cash flow is the $20,000, meaning last year, if you looked at the balance sheet last year versus this year and subtracted the two out, there's a $20,000 increase. So it was $80,000 last year apparently, and $100 this year. And then if you were to add in the beginning balance of last year, this last piece of the statement of cash flows is similar to the statement of retained earnings, right? The statement of retained earnings is tying out the performance on the income statement to what is on the balance sheet over here. So let's just do that comparison real quickly. Remember that the income statement gets to net income. If there's preferred stock, that gives us the earnings available to the common stockholder. That is tying out then to the statement of retained earnings, and it's tying out from the prior period balance sheet because the prior period balance sheet had $500,000 in retained earnings. That's what's not on the balance sheet. And then it's tying together these 2 points in time, bringing in the earnings in the current period minus the dividends to get to the $600,000, and that's what's shown on the balance sheet. So it ties out the prior point in time to this point in time. So similar things happening down here in the statement of cash flows. The top part of the statement of cash flows, all the way from here all the way down to here, represents the change. So you can kind of think of this whole top piece as basically like the income statement, because it's telling you the activity that has happened on a cash flow basis. So it's similar to the income statement. It's telling you activity, cash flows that have happened on a cash basis, and that's going to give us the change that has happened in the cash flows. And then this bottom piece you can think about as similar to the statement of retained earnings as to the balance sheet, in that here we're going to tie out the change, the difference, which is not on the balance sheet, of course. We can't see that on the balance sheet anywhere. But if we then tie out the prior period cash, which wouldn't be the cash on the balance sheet, but would be the cash in the prior period, then we can tie into the ending balance here. We can tie into the ending balance that will be on the current balance sheet. So this bottom piece is kind of doing what the statement of retained earnings can do. Now you might say, why don't we just tack on that little piece up here on the income statement? And we don't typically do that because we have this added thing that could happen in the statement of retained earnings, which will typically be dividends. So we have this added little component that we have to add in down here. We don't have a little added component in the statement of cash flows. We have the change in cash. And then if we just compare that to the beginning cash balance, we'll get to the ending cash. Okay, so the statement of cash flows will be broken out into 3 categories. It's going to be the cash flows from operating activities, cash flows from investing activities, cash flows from financing activities. The cash flows from operating activities is by far the most complex and usually the largest, and it's going to be in correlation to some degree with the income statement, meaning we're going to kind of like reconstruct basically net income to net income on a cash basis. And then the investing activities and the financing activities will deal with cash flows that take place that aren't really on the income statement. So we'll discuss that in a little bit more detail as we go here. And the best way to really understand this is to construct a statement of cash flows, which we will do in a future presentation as well. So just note that the statement of cash flows has 3 parts: cash flows from operating activities, cash flows from investing activities, cash flows from financing activities. It can look very intimidating to look at the statement of cash flows, especially when you start at the cash flows from operating activities, which is where you start because it's on top, because it can be the most complex kind of component of the statement of cash flows. But the next 2 are usually much smaller. So once you get past this first component, then you have most of it, like 75% of the cash flow you understand, right? These 2 should be much easier to understand once you have this first component down. And this is going to be equal to the net increase or decrease in cash. In other words, we'll take a look at the cash flow from these 3 components, and that's going to give us the change in cash. The change in cash from last balance sheet period in cash to this balance sheet period in cash, the difference that has happened, which we will then tie into the ending balance. So we have the cash flows from operating activities. This is the first section of the statement of cash flows and the most complex one. It's going to translate net income or income from operations from an accrual basis to a cash basis. Can be done using 2 methods. So you can think of this top piece of the statement of cash flows as taking our normal performance statement, which is the income statement, and transforming that income statement from an accrual basis to a cash flow basis. So the income statement is showing activity that has happened during a certain time period on an accrual basis. The operating activities, the normal operating activities of the company, and we're going to basically convert that to a cash flow basis. Now there's 2 ways we can do this. The most intuitive way would be, hey, look, why don't we just take the income statement, and it starts with revenue minus expenses, and then we'll just go line by line and adjust each line item on the income statement from an accrual method to a cash method. So let's just take revenue and say, okay, let's reverse the things that are accrual about it. Meaning, for example, if we made a sale on account that we have not yet collected on, then we should remove that sale because we haven't got that in, that's not included. And if we have collected on sales in the beginning of the period for sales that had been recorded in the prior period, meaning the revenue was recorded last period and we, under an accrual basis, didn't record the cash revenue this period, even though we got the cash this period, we should be recording the cash this period. And we'll talk more about that when we get to actually constructing the statement of cash flow. And we could do the same for the expenses. Let's just make every line item on a cash basis as opposed to a accrual basis. So that would be the direct method. It's easy to explain the direct method to people. It's a little harder to construct, but it's easy to explain it. And then there's the indirect method, which is the one you have to learn the indirect method because it's going to be used most often. So you want to know the direct method, and you want to, but you can't be like, well, I'll just learn one or the other, and the direct method makes more sense to me. You can't do that because most of the financial statements will be on an indirect method. Why will most of the financial statements be on the indirect method? Oftentimes it's going to be required to be so. Why would it be required to be so? Because the indirect method actually gives you a reconciliation between kind of like the net income on a on an accrual basis and the net income on a cash basis. It reconciles the two, whereas the direct method gives you, you basically reconstruct the income statement, but it's not really giving you a reconciliation to get from net income on an accrual basis to, in essence, net income on a cash flow basis. So what does the indirect method do? The indirect method is going to say, I'm going to start where we left off on an accrual basis, meaning I'm going to take the bottom line number of the income statement. So it's going to start with net income, bottom line number of the income statement, and then reconcile to cash flows from operations, meaning we're going to start from net income and back out all the differences between accrual and cash, and then we're going to end up in and back into cash flows from operations, which is basically net income on a cash basis. So again, you kind of have to know the indirect method. You got to deal with it even if it's less intuitive to you. So cash flows from operating activities, indirect method, that's the one we're going to have to basically use. It's going to start with the net income. It's going to start with net income. That comes from the income statement. And then we're going to have increased depreciation, because depreciation is something that we talked about, and we'll talk more about it when we construct a statement of cash flows, but it's a non-cash item, right? It's depreciation, that you're depreciating something that you purchased in the past, most likely, possibly in a prior time period, and now you're allocating the cost to the current period, even though cash wasn't expended. So that decreased net income, when we calculated the income statement, on a cash basis, then we would have to add it back. So if we start with net income, we'd have to add it back. Then we're going to decrease the increase in current assets. Now, I won't go into this in detail. You can kind of memorize this equation, and we'll talk more about it when we construct the statement of cash flows. But then you would have to add the decrease in current assets. Then you would have to add the increase in current liabilities and subtract the decrease in current liabilities. And that would give you the net cash flows from operating activities. Now, I know these components, like why would you do these, can sound a little bit abstract. Again, when we go into the statement of cash flows, it'll make a lot more sense. But the bottom line is accounts receivable and accounts payable. Those represents accrual accounts, meaning on a cash basis, you wouldn't have accounts receivable, because if you were recording things on a cash basis, you wouldn't record anything until you got the cash. So you wouldn't record an accounts receivable that represents people owing you money. So therefore, the accounts receivable, if you back out the accounts receivable or back out the change in accounts receivable, you can back out from basically a accrual method to a cash method. So we're kind of reversing into basically the net income on an accrual basis to net income on a cash flow basis. There's a systematic way that we can put this together. It's something that the cash flow, to construct a statement of cash flow, is something that not many people have a good understanding of. If you do have a good understanding of it, you have a much better understanding of, the double entry accounting system in and of itself. So we'll go into that in some detail when we construct a statement of cash flows. But bottom line, you need, from a finance perspective, to be able to use the statement of cash flows and understand the different segments within it so that you can make analysis on it. So we have the cash flows from operating activities. This is what the operating activities kind of looks like, or an example of it. This is just the first third of the statement of cash flows, but again, it's the longest third. So even though it's only like one of three parts of the statement of cash flows, you could still think of it as like 75% of the statement of cash flow, right? If you understand this, then you're pretty much there, right? So this is going to be the first of 3 sections of the statement of cash flows. That's the cash flows from the operating activities. We're using an indirect method because that's the method that you'll typically be seeing. It's required by some regulatory bodies. So we're going to start with net income. That number would come from the income statement. Then we're going to add back in the depreciation, which is really like the change in the accumulated depreciation on the balance sheet. So we're going to add that back in, and then we're going to take these accounts, the receivables, inventory, prepaid insurance, accounts payable, accrued expenses. Those are all balance sheet accounts. And you might say, I thought we were reworking the income statement. Why is it that you're showing me changes in balance sheet accounts? Because just like we saw that the income statement is basically in and of itself showing the change in the retained earnings. The retained earnings from the prior period to the retained earnings in the current period is the difference between the two. The major difference is the net income. Well, that same concept applies out here. So if we take the change in these kind of accrual type of accounts, then we can basically back into like the activity. So we're taking the change where we were at prior period in accounts receivable to where we are at in the current period in accounts receivable. The difference between those two is the activity that has happened. So that's why we're looking at basically balance sheet accounts to back out or back into basically the activity that is happening. So that means we're going to go through these kind of accrual accounts that are on the income statement, such as accounts receivable, which once again is an account that wouldn't be there if we were just doing a cash basis. We're going to look at the change, and this one happened to be an increase in accounts receivable. Since it's an asset, we're going to decrease it here. The inventory, once again, inventory is an accrual account. If we wouldn't have inventory as an asset on the books, if we were on a cash basis, because when we paid the cash for inventory, we would simply just record it as an expense at the point in time we paid the cash. So if we take the difference between inventory prior period and current period, we can back into the activity for it. And then we have the prepaid insurance. So prepaid insurance is an asset account that we paid for before we got the insurance. Once again, if we were on a cash basis, we wouldn't have a prepaid account. We would just, when we paid the cash, we would expense it at that point. Then we have the accounts payable change that we're recording here. We wouldn't have accounts payable if we were on a cash basis, because when we would just record the payment, not when we owe the money, tracking how much money we owe on the balance sheet, but rather when we just pay it, we're just going to record the expense at that point, and we wouldn't record the accounts payable at all under a true cash basis. And then the same for accrued expenses. So if we add these up, these are going to be the change. That's going to be the $260,000. Here's the net income before. We're going to have to add this back in to move from a cash basis accrual basis to a cash basis. That gives us our net cash flows from operating activities. So this is basically like net income from an operating activities. So you can see you have this nice reconciliation. It doesn't just reconstruct the income statement. It ties out net income on the income statement to basically net income on a cash basis. That's why, some regulatory bodies like that reconciliating item. So then we have cash flows from investing activities, the second section, long-term investment activities in mostly property, plant, and equipment. Now, the most confusing thing about this one is the second component is that usually people think of investing activities as investing in stocks and bonds or something like that. And they might have investments in stocks and bonds, could be part of it, but the major component will typically be the activity that is happening in long-term investments in property, plant, and equipment. So property, plant, and equipment, like you bought a building or something like that, or you sold a building, or you bought equipment, you bought a forklift. Those things are investing activities. They're not part of operating activities, because if you think about it, if you were to buy a building on an accrual method, the purchase wouldn't be on the income statement. Meaning, if you bought a building for $300,000 cash, like we discussed before, you wouldn't just expense it on the income statement, even if you paid cash at the point in time you purchased it, but rather put it on the balance sheet. So it's going to be something that doesn't tie out to basically the operating section, because it's even if cash went out, we put it on the balance sheet because it was an investment that we're then going to allocate the cost over time using an accrual basis method. So here those are gonna be the major investments, and most people, they might, when you hear the word investment, it means different things depending on the context you're talking about. So we're talking many of the large investment activities that will be here will be investments in property, plant, and equipment, things that we capitalize because they were large purchases. So we have an increase in cash flows, often represents a sale of investments like property, plant, and equipment, resulting in cash flow, or a decrease in cash flows generally represent cash outflows for investments like property, plant, and equipment. In other words, if we purchase property, plant, and equipment and we paid cash for it, then we have to recognize that cash flow, and we're going to put that not on the operating activities because it wasn't part of the current period's operation, but rather here in the investing activities. And if we purchase, that's going to be a decrease, right? We're going to show a decrease in cash flows related to us purchasing equipment. If we sell equipment, then we're going to record an increase in cash flows related to the sale of the equipment. Now, if there's a gain on the sale or something, that could have an effect on the operating activities, because that's something that would be on the income statement that we'll have to deal with. But if we just sold equipment and there was no gain or loss, we sold it at cost, then we would see, and we got cash, then it would be that portion of the cash inflow would be in the cash flows from investing activities. Okay, so it's going to look something like this. It's going to be a lot smaller typically, although it can be a little bit complex depending on the number of transactions that you have. So we'd have the net cash flows from investing activities. So if there was a decrease in investments, so if we had investments and they basically went down, you would expect then that cash would have been increased, right? Because we sold the investments. So cash would then go up. So an asset would go down, cash would go up, and we would record the cash flow here because there's no effect on the income statement unless there's a gain or loss, which we would have to then deal with on the income statement. And so that's a different, we'll go into that more detail later. Increase in plant and equipment. So if we bought property, plant, and equipment, like a forklift or something like that, a building or something like that, then cash would go out, and therefore we would have a decrease in the cash flow. Now, if we financed it too, then we might have a loan that would be involved in it, so we'd have to break out the loan portion, which would not be cash related, and whatnot, and the financing on the loan and the payoff of the loans and that kind of thing would go into typically the financing activities. Okay, so then we have the cash flows from financing activities. Includes the sales or retirement of bonds. Now, when you're thinking about bonds, these are kind of like, you're thinking of them as similar as notes or loans, meaning if you need to finance money for the company, we need more capital, we need more money, then we can either get a loan from the bank or we can try to issue bonds. If we're a large corporation, we can issue bonds possibly to a broader range of people, but it would still be like a loan that we got to pay back. And so we have that. We have the common stock. So when we issue common stock, preferred stock, we have the other corporate securities and payment of cash dividends. So these are all going to be in the financing activities. So financing activities, as you would expect, would be financing through us. We're trying to generate capital. Typically, you're thinking about things that generate capital. And the two ways you do that either, are with loans, liabilities, or with the some type of equity financing, like issuing stock. So that means if you're looking at financing activities, you're thinking about things like the notes, the loans, the bonds, the common stock when it was issued. When we issue new common stock in order to generate revenue in the company, issue the preferred stock, and then when we make payments to the owners of the company, that's going to be the dividend payments. So a sale of a company's securities is a source of funds or cash flows. So a sale would be cash flows coming in. A repurchase of securities is a use of funds or cash flow going out. And a payment of dividends is a use of funds or cash flows going out. So the cash flows from financing activities could look something like this. For example, cash flows from financing activity, increase in bonds payable. So if bonds payable went up, that's like a note payable, kind of like a loan, but similar to a loan. It's a bond that we owe. So if it went up, we would expect that we got money. So cash flows would be increasing because we would expect that we increased the bonds. Preferred stock dividends and common stock dividends, those are obviously cash flow that went out. So they went out, they're not part of operating activity because they're not part of like the income statement type of thing and performance statement. They're down here on the financing activities, even though cash went out. that gives us the cash flows from financing activities. So if we put this whole thing together, then we have the cash flows we got the statement of cash flows from operating activities that we saw, this whole big piece. That's the biggest piece once again. And that's going to give us our, right here, net cash flows from operating activities. Then we've got net cash flows from investing activities, which is much smaller, you can see here, as we looked at. And then we got the cash flows from financing activities. That's going to be this component here. Now, if we were to add up those three components, that's going to give us the change in cash flows. So if we add up those three components, 420,000 plus the 390, I'm sorry, minus the 390,000 minus the 10,000, that's going to give us our change. So that's like what happened during the current time period, kind of like the income statement, where we would say how far did we go in the current time period, what was the change in cash. Now, cash could increase or decrease, right? Whereas revenue, you would expect always to be increasing. You know, you're hoping that it's going to be on the increase type of thing. But in any case, you're going to say, what's the change? How far did we go in the current time period? That's going to be the activity. So if we started from, for example, if we started from 0, if we put the odometer at 0 and counted up, we would have said now we increased by 20,000. Obviously, cash went up and down. It didn't go just one direction because cash is flowing in and out here. But we had a net increase of the 20,000 in the cash flow. And then if we compare that and we say, okay, well, we weren't at odometer 0 at the beginning of this race, you know, at the beginning of the time frame. We had 80,000 currently as of prior year on the balance sheet in the prior period for cash. And it's like, okay, well then if we started at 80,000 and we increased by 20,000 for the year, that means we're at 100,000 at the end of the year. This is going to be that kind of like the statement of retained earnings that ties out the balance sheet and the income statement. This is the bottom portion of the statement of cash flows that ties out the balance sheet of the prior period to the balance sheet of the current period, the 100,000, then showing on the balance sheet here for that 100,000. So here we have all of our statements. So just to recap, remember that these three statements, when you think of the financial statements, you think of these two first, balance sheet, income statement, and then the statement of retained earnings, linking those two together. Then we can kind of think of the statement of cash flows, reconstructing the balance sheet and the income statement. The first portion of the statement of cash flows, basically reconstructing the income statement, but often doing so with an indirect method, meaning we're going to start with the net income on the income statement and reverse back into the cash flows on a cash statement, or net income on a cash basis, as opposed to a direct method where we would do each line on the income statement in accordance with a cash method as opposed to a non-cash method. Then we have those cash flow items here that are not part of normal operating activities, and that includes the investing activities that they're not reflected in the income statement, which are normal operating activities. Even if we paid them for cash, for example, purchasing equipment, even if we purchased it for cash, we put it over here in an investment because it's going to be, influencing future periods. That property, plant, and equipment, the purchase and sale of it, is the major component, cash flow related to purchase and sale of property, plant, and equipment, major component of the investing activities. Although we could have other investments that do increase and decrease as well, you'll find that the property, plants, and equipment is a major component of these investing activities. Financing activities deal with the liabilities here, increasing and decreasing of the liabilities, because that deals with financing of the company if we're trying to generate capital through some form other than revenue generation, other than income generation through revenue. And then anything that deals down here with the stockholders' equity, such as issuing the preferred stock or the common stock in order to generate financing activity. We're issuing stock to generate capital, money in the company. And then the giving of dividends, the distribution of dividends will be down here. That's going to give us our change. So the net change being here that we saw. And then if we tie that out to the beginning cash, which isn't on any of these statements, where would it be? It would be on the balance sheet, but for the prior time period. And that then will tie us out to the current period, the balance sheet on the current time period. This bottom component then being the link between the last period cash balance and this period cash balance, the last period's balance sheet, and this period's balance sheet.